Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. We're going to dive right in, take a look, see what's going on today. If you want to follow me at _finance, and if you want to join our community, finding-value.com, that's where I look at all these opportunities, looking for potential investment opportunities and sharing them with everyone in the community. It's mostly commodity related stocks, as that's what is in cycle. That's where the value is. So I cover a lot of stuff in the commodities space. I can cover other spaces too, and I can look at other sectors for you guys during the Q&A sessions. But I may not know as much about it because I don't do as deep of dives in other sectors that are more expensive. So I don't focus my time as much looking at those sectors. If you're interested, specials the coupon code. Special, you type that in, you can get 50% off the monthly membership for the first month only, or you can get a larger discount signing up for a yearly membership or swapping from a monthly to a yearly membership. So let's dive in. Let's take a look, see what's going on today. So we've got the Hedges Horseman, 10 bagger shot. Don't trade the stock for 3 to 5 years. Well, I'm holding longer than 5 years. I purchased in 2020. I'm still holding my uranium and oil companies that I purchased in September, October of 2020. And I'm going for, fingers crossed, I am hoping that I can get maybe a handful of 100 baggers. Maybe. It is possible. I think I've got a good shot for it. So that's what I'm trying to do. And what I'm trying to do is I'm trying to figure out the cycles as best as I can. And that's where I came up with the three pillars. The three pillars approach: ratios, technical analysis, and market cycles. That's what I think is required to master this game, the game of investing. So that's kind of what my goals are, is to hold longer than 3 to 5 years. 3 to 5 years will get you through wave one. It won't even get you through a bottom and wave one together. And I'll show you what that looks like real temporarily, maybe, if I feel nice enough to show you kind of what that looks like and what is coming. So yeah, you need to be able to hold. What we are doing is we are exploiting the impatient or impatience of people. And we are applying patience to our strategy to take advantage of everyone else. I am not sure if you can make money in the markets repeatedly if you're incredibly impatient. You can look at statistics and data. The longer you hold stocks, the more likely you are to make money, the longer you hold them. So people think of, oh, it's just going to buy it and it's going to go up immediately. That's not how it works. You obviously don't know the game, in my opinion. The game, if you're going to play it successfully, you need to know what you're playing. You need to know who you're playing against. And you need to know what their weaknesses are. And you even need to know what your strengths and weaknesses are. Then, if you're going to be successful at a particular game, you need to figure out how to play that game. You may need to change your skill set. You may need to change the way that you're approaching the markets. And that's that's what I've done my entire time here, is to figure out what approaches, what strategies, what should I implement, what shouldn't I implement, to get the best returns over the long run. Steve AG said, silver price suppression caused supply deficits. Banks have much less silver than claimed. There are now three groups bidding for silver: industrial demand, awakening monetary demand, banks trying to avoid default. The silver arm wrestling is over. Life-changing opportunity is now. I don't think the silver price was necessarily suppressed for a long period of time. What I think occurs is that we were riding on the cost curves the entire time. And there was manipulation going on, like intraday and some of that stuff. Yeah, for sure. And then we've got all this, we'll say a ton of paper supply absorbing paper. I don't think that they suppressed it underneath the cost curve. I think they just held it on the cost curve of a lot of these producers. And then every once in a while, you'd get a flare up and it would go way up. The question is, when do we get the flare ups? What market conditions causes these flare ups? And yeah, it is demand. And historically, the demand has been flared up from monetary issues, generally increasing inflation and increasing interest rates. Now we've got this wave of three. It's industrial monetary demand. And then another one says banks trying to avoid default. I don't think that's demand necessarily. I think the demand is coming from central banks and the inability for bonds to be held as a store of value. That's the increasing interest rate environment portion. So central bank demand, awakening monetary demand from, I would say, individuals, and then the industrial demand. I can't pronounce his name, but it says, you know what to do, time to be a contrarian. And he's showing the dollar index and yields with around a 9 month in advance of the 2 year yield. And then we could get a move higher in yields for a period of time, which is going to push the dollar for a short period of time. JC Parrott says, what's your favorite Wall Street movie to watch? Well, we've got Margin Call. We've got The Big Short. There's Rollover from 1981. There's what's up? Trading Places. That's not too bad. My favorite, there's parts of each one of those that are really good. There's parts in Margin Call that are good. There's a lot of good parts in The Big Short. The one that I like The Big Short probably the best. Trading Places is kind of funny too, which is it Dan Aykroyd and not Charlie Murphy, Eddie Murphy. Eddie Murphy's in that one too. But I like The Big Short the best. I think that's got a lot of good stuff in it. Mark Baum. I like when he's on the phone with God, what's his name? The banker guy, and he's got his shorts, and they're becoming very profitable. It's like right at the beginning when things are starting to move in favor of the shorts that they had on the swaps that they had. Mortgage-backed security swaps, I think, is what they were. And he's like, I'm lit to the, or what is it? Something to the tits. I remember that one. And Mark's like, no, we're going to hold. It's like right when things got moving, everybody wants to sell. And he's like, nope, I'm going to hold. And you make the money by holding. And I think that was the best part of the movie is just trying to hold and not selling out quick from a financial perspective. The best part of the movie, from a funny perspective, is when they're interviewing those two mortgage brokers. Now I own a boat. Yeah, that's a great one. Great quote. Anyway, U.S. government debt market collapse has begun. This has massive implications for the economy. Yeah, you got the shoulder, head, shoulder pattern here, and it's broken its uptrend. Yeah, it looks pretty nasty heading lower here. This is the reason that gold and silver are going to go up. You're staring right at it. This money was all flowing into the bond market from 1982 upward. It was in one big uptrend. Now it's in a downtrend. Money doesn't want bonds, doesn't want to go there. So interest rates are going to go up, and money's going to look for other avenues of purchasing power preservation. So bonds are not it because they're going down in bond price. It's going to be gold and silver and hard assets. We've got against all odds. He says if crude oil closes above $66, we get a false breakdown buy signal. That's the level. That's the trigger. Well, I mean, if you look real close, that's a shoulder, head, shoulder inverted. It's the same one. This one's a regular shoulder, head, shoulder. This one's just inverted. Shoulder, head, shoulder, line going across, and we've broken out of that. So yeah, we still need to break upward, but I'd say the bottoming pattern's there. This thing is just a matter of time. And everything else that trades with crude oil, like platinum, that's breaking out. Copper, well, that's pretty much breaking out. Pretty much everything else that trades with copper that's inflation sensitive, like fertilizers and other things, well, they all look pretty dang good. So I'm in the camp that crude oil is most likely going to break up. That's where I'm at. The Great Marti, ladies and gentlemen, I present to you 200%. Thanks for listening. And this is the Buffett indicator, significantly overvalued. According to the Buffett indicator, the stock market is significantly overvalued based on today's updated data. The market cap to GDP ratio is 200.8%. Now, think of the best investors in the world. What do they tell you? Margin of safety. This here is the antithesis. Is that antithesis of undervalue. It is significantly overvalued. It's where you don't want to be. And that's what keeps me away from certain sectors. So valuation in itself will keep you in the right parts of the market. It will also prevent you from buying overvalued sectors that you don't want to be in. Now, that doesn't mean that the overvalued sector can't go up. It just means that your margin of safety, where the risk is greatest, you're not in those locations. So that's kind of how I view the markets. And I think valuation is the one thing that we can measure and the one thing that can keep you out of trouble and get you into great opportunities. It's the one metric that kind of squares everything off because you can't really time the market in the short term. So timing comes off the table. You can use technical analysis, but it doesn't mean that your risk is low just by using technical analysis. You want an undervalued opportunity that has good technicals, that is in an undervalued sector, that has a lot of room for growth. I mean, it starts adding it all up. Brian Feroldi says, I'm a long-term investor. Investors who say they invest for the long term, investors that actually invest for the long term. And why does this matter? Why does long-term investing matter? Well, it depends what strategy you adopt. If you actually want to make money, more than likely you're going to be a long-term investor. The reason most people underperform the market is because they're trying to time the short term. They're trying to jack around with a bunch of things that are out of their control. They're trying to time things, and they mess up the timing. Now, if you mess up the timing, hypothetically speaking, and you buy an undervalued company, well, what do? You just sit in it and wait. You wait for it to come back into good market sentiment. It gets repriced higher, and you win. That's why buying undervaluation trumps all. It keeps you out of the bad, overvalued areas. Basically, it prevents you from FOMOing, the fear of missing out and jumping into a stock only because it's going up. And it keeps you in the right locations if you're buying undervaluation, aka margin of safety. Because if you screw up the timing, you can wait it out. You've got valuation at your back. What do you do if you don't even know the valuation of a company? Oh, we'll put a tight stop loss and just sell it. That's what most people do. Now, is that a great strategy? I don't think so. Do you know how hard it is to buy some of these stocks that are incredibly volatile and to put a 6 or 10% stop loss? You're going to get stopped out of everything. They can move 6 to 10% in a day with ease. How do you time something like that? I mean, you could buy it in the afternoon of a Tuesday and Wednesday morning you're getting stopped out just because it gapped down, and then it rockets back up to where you bought it in the first place that same day. So volatility scares people, and trading in the short term with these tight stop losses kicks everybody out. And I hate to say it, but I bet you the algorithms, I bet you they can see the limit orders that are in there. I bet you they know where they're at. And I bet you they may sell stock to trigger larger, like they'll make a determining factor, let's say. And I bet you they can see the orders depending on who's making the market makers. I bet you the algorithms can see it and they'll say, I can sell off $10,000 worth of stock, bring it down into these sell orders, and buy $50,000 worth of stock to go long, and then drive it up from there, basically soaking up all of those limit orders at a certain price. JC Parrott says, everyone knows all the financial morning shows are unwatchable, whether on basic cable or on YouTube. So you just had to create one that actually adds value for traders and investors. ARK stocks are flying today, and we're right here talking about it. This is ARK ETF rolling higher. Most everything is rolling higher. Most everything. Do you know how everything goes up? Inflation. More money in the system. It's the only way that everything can go up. Inflation into the system, coming into the system. It could be a lot of inflation. That's when everything goes up. Liquidity and inflation. It is impossible to have everything go up at the same time and not have inflation. Egon says gold is nature's money. It's not printed, not promised, not political. It's the only monetary asset that has stood for 5,000 years. Well, we made it a monetary asset. And of course it stood for 5,000 years. It's an element on the periodic table. That element we deemed as money. Humans did. Nothing's been able to replace it. I still don't think that cryptocurrencies or anything else is going to be able to replace it for any length of time being hundreds of years. Is anyone even willing to sell their silver at $40? I'm not willing to sell my silver, but I could make a potential case where we could sell silver. If you did a platinum to silver price, so here's platinum to silver. I could make the case that it would be better to buy platinum than silver based off of the platinum to silver ratio. As you go down in a falling wedge of 3 humps into the corner here, and look at the corner, could get a big breakout of platinum outperforming silver, which is a possibility. I'm not saying it will 100% happen, but that is a possibility. So would I sell my silver for platinum? No, I wouldn't, because I purchased a lot in both, hedging myself. I don't have to be one or the other. That's a lot. I hear that a lot of times with a lot of people. What they'll say is, well, what would you buy? What would you do, X or would you do Y? Well, what about this? What if X has a potential return of 10X? And what if Y has a potential return of 10X? Well, wouldn't it be smart if I could buy both and capture the returns of at least one of them? Because if I put it all in one, and let's just say it's potential returns, it doesn't mean it will return that, it's the potential. If I put it all in one, what if it doesn't return as good as the other one? If I put it all in the other, what if that one doesn't return as good as, say, the first one? So if you get these large asymmetric opportunities, it's not about guessing which one is going to be the most successful and then dumping all your money in one thing. What if you identify like 5 crazy setups in let's say it's sectors, 5 crazy sectors, and they all possess patterns that are gigantic, they're squeezing up, and can produce ridiculous returns? Wouldn't it be better to go after all of the opportunities if they were pretty equal in valuation and potential returns and risk reward, to spread it across and capture whatever those market returns are? You also diversify a little bit. So if one starts to move a little earlier than another, you're capturing that return. And you don't have to win on every sector because these things are at 100% certain. So you don't have to win on every sector to win big. You only need to win on a few of them. So if there's 6 opportunities, you only need to win on maybe 2 if the asymmetry is so big. Asymmetry is if I risk money, I get 10, 20 times my money back or more, depending on what it is. And then you evaluate the subsectors. You look at what has the risks and which ones are maybe riskier, and then you can allocate based off those certain things. So this is what I see. Platinum, yeah, it could be insane, but go look at a long-term silver chart, and in all honesty, I can't stop looking at this thing. This is a long-term silver chart, and it's literally it's the same pattern that repeats over and over in every single one of these. There's a little bit of a squeezing on the pattern, so you can kind of roll up like this, and then this one, it's kind of squeezing up at the top there. Could be something like that. Depends how you look at this, but either way, uh, it's a repeating pattern. These are all bottoms there, moving on up with time. So I look at this big, cup and handle. Everyone talks about the cup and handle. There's the interest rates that you can tie along with it, all that stuff. But this is the cup and handle that everyone's talking about here. It's right through here, and we're coming on up. You can even probably draw a line going up like this. There's your cup, there's your handle, and that's breaking out. And the bigger the bigger the size of the pattern, the bigger the move that generally transpires from it. So this is a big pattern. Yes, it's going to most likely just absolutely outperform. We've got all the conditions. The increasing interest rate environment occurred from here to here. That was an increasing interest rate environment. And now our consolidation is the declining interest rate environment, which stopped in 2021, which is basically here. And now we're starting to go up again. And I think this is going to it's going to produce an insanely big move. The last move that did that from bottom to top, even though it was a very long period, was 9,056%. That is what I think a big move's coming. I don't know what it will look like exactly, but um, that's what I think is going to occur. And I'm just going to do a fractal. Let's do a fractal here. So this is kind of the double bottom that we got here, and we'll make the double bottom roughly the same. So that's what I think is going on here. It's a little bit squeezed up, and then we can do something like that. But that's what the last bull market did. I got to make it smaller because it's actually this. I can get it small. There we go. There we go. So something like that went sideways, and now we're starting to move on up. There we go. There we go. So maybe we get something like $300 silver or something. Yeah, maybe 300-ish. It could be more than that. But I'm getting like 300-ish dollars. I got 360. If you do this, you get probably roughly the same projection there. Yeah, it's very similar projection. And I'm just kind of like floating it. It could be like that. Yeah, 360, 380, something like that. Definitely possible. We're still coming up. S&P Metals and Mining ETF XME is pressing up against the upper end of this massive 14-year base. Look at that thing. Get a little bit of resistance there. Metals and Mining ready to work its way on up. It's a 5-year downturn. Huge double bottom. Run a line through the top like I normally do, and we've been working our way on up on the right-hand side. Copper's a big driver of this one, I think. Diversified metals, copper. Latest comparative inventory analysis using EIA data through 5/30/2025. Total commercial petroleum stocks, excluding other oils, implies a fair value WTI price of $93 a barrel. Using just the commercial crude oil stocks implies a fair value price of $82. So depending on which one you use, we're somewhere between 82 and 93. We are way lower than both of those prices, which is good if you're looking at oil investments. Here's a silver bull analog. This chart plots the 4 best cycle bull moves in silver on a scale of current move. The average high in 2025 is $45 an ounce. It begins to accelerate January 2026 as it breaks $50 an ounce. In his opinion, we've got the average, which is the dots between these, and then we've got 2024, which is the black line here, working its way on up. And we got a little bit of sideways action before we go higher. The sideways action, sorry, it might be this here, sideways. Let me go in there and look. Oh my goodness. So this will probably shift left. Maybe we got a little bit of sideways action before going up. Get a breakout up to $62, a retest of 38, 35, and then a big break. Heading out into the 2020s or 2030s, I'm not sure. This isn't going to be perfect, but that's what it shows. Something like that. Tavi says the gold to silver ratio is now breaking down as silver accelerates and begins to catch up with gold. Just a month ago, investors were telling me this time was different, that the ratio wouldn't revert, and we were witnessing a structural shift. But notice the trend. Interestingly, many of the same voices are now claiming that early stage mining companies will never attract capital again. In the investment business, whenever you hear the word never, it gets my attention. Capital is clearly flowing down the chain. It started with gold, then moved to royalty companies, then from there, senior producers begin to rally. Now, copper and silver are clearly gaining momentum, and in my view, the next stage is likely to be early stage mining companies. And we are positioned on the website for a lot of these early stage mining companies, developers, we call a lot of them. But this looks good. That this ratio, it's undervalued for silver, and we're going to get a move lower in silver. And I did do another interview with Uselink, Casper, and you'll see that later in the day if you listen to this in the morning, where we'll talk about some of this and what's coming with gold to silver and mining companies. Rock Bottom Entry says we will not see a stronger commodity bull market in our lifetimes. Shoulder, head, shoulder, and we are heading higher here out of this falling wedge. So when you look at these, and I'll just take this and draw on it real quick. I'm going to copy the image and do a nice little paint for everyone. This, you always see this. It's pretty ridiculous. It is a falling wedge into a double bottom. Your double bottom is that, or sorry, this one here is not a double bottom. This is a shoulder, a head, and a shoulder, and your double bottom is this and this rolling across there. So you can get inverted shoulder, head, shoulders, or you'll see a double bottom out of these falling wedges. Happens all the time. It's all over the place. So what we've been doing is we've been picking off bottoms or trying to in some of these areas around here. It does require some patience. And then we're waiting for the big bull market to start. And this one's already starting in this particular one. If it starts and we start to move higher, we can also look at other areas and sectors to catch the lagging sectors. There's a couple sectors that are lagging where things are still way down. Energy is down and energy service, and then there's other ones too. This is silver, long-term price target for silver based on the cup and handle pattern. I was getting a lot of stuff in like the 300s N-ish. Now he's got this one on logarithmic. He's getting it at 600 and something dollars, 668 looks like, at a 1.68 price target using the ultimate peak here. I used it a little bit lower at a different closing price. He's using a 6-month closing price. But yeah, you can get a little bit different projections. The projections aren't important necessarily. It's just that the big pattern exists and we're starting to break higher. That's the most important thing. You try to capture as much as you can out of these bull markets. Freight futures AM update. We've got dry bulk, Capesize is flat, Panamax is down 2%, tankers, VLCC is up 1%, Suezmax is down 1%. WTI is no longer range bound. Futures price rose $3.79, 6%, from 60.79 to 64.58 for the week ending June 6th. we are coming out of this range bound by Art Berman to the upside of the Bollinger Band. Peter Lynch says, buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle. I've done a lot of thinking on this one, a lot of thinking, and it makes a lot of sense. There are certain sectors that I'm far more bullish in than other sectors. And I go after the ones and try to understand what I think are the best opportunities and the best sectors in the market. So I'm buying what I understand and believe in and intend to stick with. There are other sectors that I struggle to hold on to. The main difference between them is, I would say, cash flow versus no cash flow. So companies that are they dilute you versus companies that make money and buy back shares, as an example. So I think it's totally true because I can see it in my own actions. I can feel it. I can see it on the companies that I have conviction in versus the companies I don't have conviction in. One is it can create its own demand for its stock. The others are completely dependent on money flows from other people coming into that sector and buying it up. So yeah, I see it in my own investing even. Here's Grady. He says, when the ratio chart breaks above the blue line, the big move in silver starts. The silver to gold ratio here, which is the reverse of gold to silver ratio, has a cleaner pattern than GSR. When this ratio chart moves up, silver outperforms gold. This looks like the final back test. The chart is now ready. So it says, when the ratio below starts to move, fortunes will be made. Fortunes will be made. And it's coming right now. We're about to break out. This is expanding, falling wedge. They're very bullish patterns. And when silver starts to move, you're going to see mining companies move too. I hope that you guys are positioned for this. You can see the Elliott wave pattern, 1, 2, 3, 4, and then 5, all the way up. It's coming. It doesn't mean it happens in days. It's a big pattern. It takes time, and they're going to be big moves. So you got to get your time frames right. Don't mess up your time frames. Some of these might take a little bit. Patience. Here's another one. It says silver's breaking out of from a 45-year bullish pattern. SILJ here is breaking out of a 4-year bullish pattern. Life-changing gains is hard to accomplish. This both because the best market opportunities for it are few, and because it takes everything you have got to do. So fortunes will be made, getting out of the rat race will be doable, but you need to play it right. When the bull resumes, it's vital to change mindset. One can only play a bull market with a bull mindset, not with a bearish mindset. If you doubt the bull, you will not be able to change mindset. You have to believe in the bull, or you end up being a victim of the wall of worry, i.e., your own emotions. Most need help with this. If you cannot grasp the new market environment, you'll be hardwired to sell as soon as you have a little profit, since you will expect the sideways down and big drops from the bear market to continue. And if you sell too soon, you will have messed up the great entry and opportunity. If you were able to pull the trigger at the very lows, that is, which most cannot do either. So here he bought heavily at the service and added on these pullbacks. We've got the breakout. It's ready to go. That's SILJ. Brian says success is okay. I think I talked about that one before. So we're going to end it right there. That's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special is the coupon code if you'd like to use it. I'll be releasing a midweek update here for Wednesday. I know I'm releasing this on Tuesday, so look for that as well. That's where I share my opinions on individual companies, what I'm seeing in the market, and what I would be doing myself. But that's all I've got for today. We'll catch you next time. This is Finding Value.